Everybody, 416 here, November 4th. A lot of things to cover today. I'm by myself today. I think the cold bug is getting a lot of us these days. Certainly, COVID and other respiratory things happening. So, on my own today. Hope everyone's healthy and doing well. But I got to take this time to go through number of things that's happened this week, as well as I got about a 7 or 8 pager that will cover some of the updates of what happened, what's going on. If you read my daily today, you'll see that we comment a little bit on interest rates this week and central bank and what they said or didn't say. And next week's a big week with the midterms coming up in the U.S., so we'll be watching that pretty closely. So, but before anything else, we're going to jump into the presentation here. Just bear with me. You'll see us for 1 second, and then we'll jump up here with the presentation. So, all right. So hope everyone can see this okay and it's doing well. So I put this up recently. I'm not sure if I covered it in last week or not, but I've been using it in a bunch of presentations, and at least we've been talking about it the last couple of weeks. And this is really a view of ISM, which has historically been a signal for the strength of the economy. So it's a manufacturers index, and it tends to be a gauge. If you're above 50, the economy is expanding. If you're below 50, the economy is contracting. So recession or an expansionary economy. So as we look at these white lines here, like these have been the ISM numbers since 1970. And then the blue line, of course, would be the Fed funds rate. And so they've been having lots of questions around we'll say the terminal rate, because Powell likes to use that in his speaking, just saying, we have a new terminal rate of 4 or 5, whatever that number is that he sticks to. So they talk about this terminal rate. One of the more key things that I do want to point out, which is just the length that we stay at the different levels when we reach them. So if we looked historically, we've had quite a few period of volatility. Excuse me. In the 70s and 80s, and this has been more of an inflationary impulse, similar to what we see today, is where we see the rates peak out, and this one lasts about a month and a half, and then they start cutting rates. These ones reach a peak and cut right away, so there's a reversal in the next meeting. And if we go across the different time frames, and then kind of 2008, it took about 9 months, I believe, in 2008 before the first signal. And then we saw 2020, which was quite quick, and then we stayed there for a long period of time over these last couple of them. So we see rates here heading up towards the 4%. And the thing that I'd like to point out is that we've typically stayed at these levels for, on average, 6 months. So if you think we're getting close to the end of the rate hiking cycle, and Powell seemed to indicate that they're considering it. He said, we're not ready to make that decision just yet for where the peak is, but he has said we're considering rates coming down in the not too distant future. I thought this was an interesting place to look at it, just really how the market reacted to it. And we've had a couple of volatile days since then. On Wednesday, when the announcement came out, is markets initially gapped up on the 75 basis point. Then they had a meeting. Some of his comments they sold off. And then we had Thursday market sell off, and then Friday today we had a rally again in rates and markets, and US dollar down pretty hard today. And so this is just a reasonable picture to see how the curve has shifted slightly. Ultimately, though, the path, as I've said before, is projecting to be lower levels. And so the question isn't when we get there. The question is, when does the market come to the realization, the comfort with that rates are going to start to come down. So this is an important narrative that will continue to follow as things progress from here. So I thought this was an interesting thing to think about, where I've talked a little bit about the kind of the financial conditions are tightening, and so we've had the most aggressive financial condition tightening that we've seen from March until today, that we've seen in history. And so not only that is we have global coordinated financial condition tightening at the same time. And so there's been lots of talk that the banks are flush with capital and there's so much money in the bank accounts, that these banks have nothing to worry about. But one of the side effects of rates moving up is you get this period where it didn't matter whether you invest in money market funds or whether you invested in a bank account. It just didn't matter. And so we faced these last couple of years where you could be in either of them and you didn't get paid to do that. But as a result of rates moving up, this is both in Canada and the US, if you've seen a massive exodus of money flowing out of bank accounts and into alternative yielding assets. So they'd be moving towards money market, and this is US data, so kind of 2.5. Canadian money market would be a bit higher than that. And, Canadian 1-year GICs are, excuse me, closer to 4.9%. So you're getting money pulled out of the system, and that's going to be negative for banks, at least in the short term. And so this is an interesting thing to pay attention to around what this impact's going to be kind of medium term. So over the last couple of years, I have talked a little bit about active and passive, and I thought this was a great chart that I came across this week, and just shows the different decades around when certain things did better than others. And so we went through a period where active management here, through this inflationary kind of similar setup, excuse me, where active management made more of an impact on portfolio returns than passive management did. Then we entered the late 80s, early 90s, and we had that kind of suck of money into the indices, and that pushed and passive out returned. Then we went into a period kind of sideways market of 2000, 2011, and then active outperformed. Now, as I mentioned before, I think it was in my annual report that I mentioned where, I think we probably reached peak passive November of last year. Now we're starting to go in the other direction. So, as we see this start to tick down here where active makes more sense than passive, some of the decisions that we're going to make are going to have an impact on that. What do we own? Why do we own it? Do we need to be a bit more active here as opposed to just buying the index? And so this will be something that we'll pay attention to over the next couple of quarters and years. So, I read the headlines, as I'm sure you guys do as well, and then you look at the data that comes out. You get these headline reports from the employment, non-farm payrolls. You get the kind of beat expectations, but unemployment is rising. It's kind of sometimes hard to balance those two. So I thought this was an interesting place to look at. This is the U.S. numbers as of today. And so if we look at the kind of the difference here is that we've had a lot of full-time jobs lost, a lot of part-time jobs increased, and you got a lot of multiple job holders. And so that data itself, while is a lagging indicator, is still worth taking a grain of salt with. And if we look at what's happened in these quarterly earnings, well, we've seen it where Lyft's cutting 30% of its workforce, Stripe 14%, Chime, Twitter, of course, with Elon Musk taking over, is cutting half its workforce. The banks are also cutting a percentage. Amazon, Apple both have announced hiring freezes. So, this is a lagging indicator. So as Powell and Macklin look at these numbers, the employment numbers are interesting and worth paying attention to. These are lagging things that are happening already. So as they think about future rate hikes, I think this starts to play a bigger role in their thinking as we move over the next couple of months. And so I don't know if I did include the fiscal update from Canada in the report today. There's a couple slides I wanted to pull out of there just to comment on. So if you haven't gone through it, here's a couple charts that I thought were interesting. What I found from the central banks is they're all commenting on what's happening in other countries. And I don't remember a time where we've seen this happen, where it's usually been more focused on what's happening in their local country. But this is Canada talking about inflation in some of the other countries. Obviously, Canada would be further down the list here. But what I found more interesting is the actual forecast for where they think inflation's going over the medium term. And so, if this is their path, present path, at least the dotted line, and it's rare that they hit the actual dotted line. But if this is the current path, then that view that rates come down next year is pretty much aligned with what the Department of Finance is thinking about in Canada as well. So interesting data that I thought to comment on, just have a look at how that plays out. A couple other things that I found interesting, and as we look at Canada spending more time on clean energy, and they had some interesting projects that they're working on, more money going towards clean tech and things like that, and starting a new fund and some other things. But this one I found was quite interesting too. So the government had put some money available for the different provinces towards clean infrastructure. And so as we look at the how the different provinces have deployed those funds, you get some outliers here where Quebec, they still have a big, more than a couple of $1 billion of money to put out in these projects, and it has to be implemented by January of next year, excuse me. So I'd look at this, and it's given me some pause and some thought around where these monies are going to be deployed, what companies are best positioned for that, potentially like the Northland Powers and things like that of the world. So I thought this was an interesting piece of money still to be deployed as we move ahead here. So we've talked a little bit about Ethereum, and they went through that change from the proof of work to proof of stake. So that's resulted, as I mentioned, in a 99% reduction in actual electricity costs, because you don't need the proof of work machines running behind the scenes to verify that. Additionally, what it's done is it's made the ETH supply pretty much neutral. And this is 50 days since the merge. So this is today's data. And so what I thought was most interesting is that if we look at this, this would have resulted in something in the neighborhood of 500,000 in additional Ethereum coming online had they not made this merge and change. So that's interesting. Additionally, we saw this week, we saw JP Morgan do a blockchain transaction. It wasn't DeFi specific, but a blockchain transaction on the Ethereum chain with Paxos, which again, as we look at how these things play out, I do think blockchain plays a major role in the future. And so these are some of the interesting things that came out on the blockchain side this week. So, excuse me, I'll stop sharing there. Get our screen open again. So so that was it from an update from the market's perspective. We saw Chair Powell come out this week and say they're going to raise 75 basis points. If you look through what he said, and the market kind of reacted a lot to his comments, and he seemed to indicate they're going to continue to raise rates. And I think from my presentation either last week or the week before, is my view was, yes, Canada is actually ahead of the US right now. And if you look at how things have looked in the world, Canada's up 3.5% off the lows of March of this year. So they've increased the most of any of the central banks of the world right now. And so I'd say the likelihood of the Bank of Canada being on hold quite a bit sooner than the US is continues to be very high. And so, and if you look at Macklin's comments and some of the other Canadian central bankers, they seem to indicate similar things where they're more likely to be on hold sooner than the Federal Reserve. And our real estate market is different than the US. So, I think Canada is extremely close based on what we've been hearing. If we listen to what our economists are saying, and we had a conversation with our CEO as well, they think they're quite close to the top of Canadian rates. So we'll continue to watch that. But the US Central Bank, I still think it looks like rates are moving higher. From a technical perspective, it looks like that as well, at least on the short end. And so we'll continue to watch that quite closely. Coming up next week, we have on Tuesday, we have the midterms. Lots, I think, will come out of that one. Be interesting to see how that flows and what happens coming out of that. I think it gives the governments and the central banks in the US a lot more freedom after we've got past midterms where the focus has been kind of almost exclusively on inflation. And so we come out the other side of this, I think there'll be a lot more comments around employment and global economic slowdown. And I think there'll be more free to speak about some of the other things that are happening in the world. So, so that's what I'd be watching from a transactional perspective this week. Not a lot of changes, just continue to wait and watch. Some of the holdings that we'd added to, like the Chinese internet, KWeb, had a reasonable rally. Today was up 8.5%, We've seen a good move off the bottom there. We've seen some of those names start to pick up a little bit. So continue to watch that. And as I said, in the last couple of weeks, the economy and the markets are two different things, and they operate at two different times. So I continue to have the view that we're in the early stage of a recession, and the market is in the later stages of a bear market. So we continue to operate with those terms and thoughts and continue to follow the data quite closely. So if anyone has any questions, please shoot, let me know, and I can answer them here, and I'll wait 30 seconds or so and continue to talk a little bit unless if someone has a question. I guess the one thing I didn't comment on was gold. We had a bit of correction, but then a rally back today. So U.S. dollar weakness, gold and silver strength today. So we'll continue to watch those two things and how they work together. And I think that there's good upside from the gold and gold positioning over the next 9 months, but really correlated to the U.S. dollar right now, which many and all assets are today. Well, thanks everyone for joining. So do let us know if you want to have meeting conversations. I have been going through tax loss selling, cleaning up accounts, making some changes there from a tax perspective, shifting from one holding to another to realize some of those losses and better position for what's ahead. So any questions, feel free to give me a call, give Scott a call, book a meeting, and we can go through them together. So appreciate your time today. Hope everyone has a nice weekend. Looks like it's going to be beautiful. Enjoy the last little bit of summer here, and have a great day, and we'll see you soon. Thanks very much.